So you're welcome to the Directors Dialogue, an official podcast of the Chartered Institute of Directors Nigeria. And in case you don't know, the podcast aims to strengthen engagement with members and partners, promote thought leadership on corporate governance and business ethics. It also sets to position itself as a national and a continental authority on leadership excellence, while also reaching out to a wider audience, including emerging directors, policymakers, and global partners. That's what the show is all about. But then when you look at the Chartered Institute of Directors Nigeria itself, well, it is a leading community of directors and business leaders across all sectors in Nigeria's economy, so to speak. And we are all about helping directors grow, lead better in the industry, and make a real impact in their organizations and beyond. So, over the years, CIoD Nigeria has worked hand in hand with government bodies, top corporate businesses, business chambers, corporations, while also facilitating our partnership with diplomatic friends to raise the bar for good governance and leadership in Nigeria. And it's this particular commitments that keeps attracting exceptional leaders and forward-thinking professionals to the institutes, and that's what we are all about. So this particular time we'll be looking at certain areas which actually to do with Nigeria's 2026 tax revolution. And the focus is a director's guide to governance, risk, and responsibility. But there will be narrowing down today's conversation to strategic oversight, ethical implications, fiduciary duties under Nigeria's new finance acts. And I am not a professional here. I have a professional in the industry that would be sharing his expert knowledge with us during the course of this conversation. I'm talking about Dr. Biodun Adedipe, who is a Nigerian economist, a strategist, a consultant with over 4 decades of postgraduate experience spanning academia, investment banking, project finance, management, consulting, and the like. He also served in a number of high-level government advisory roles, including membership of federal committees on currency denomination and expenditure review, and also a senior special assistant to the president on financial sector development. His professional affiliations include fellowship of the Chartered Institute of Bankers of Nigeria, membership of the Chartered Institute of Directors Nigeria, and other respected institutes. So, Dr. Biodun Adedipe is the founder of BAA Consult, a seasoned economist and business strategist with a PhD in corporate finance, as I said earlier. More than 45 years of experience across banking, consulting, and government advisory, and a recognized voice of leadership and economic policy in Nigeria. So I must let you know that the person I'll be talking to right now is a top shot, a big wig in the industry, and is going to be sharing with us the knowledge that is needed for you and I to have an understanding about Nigeria's new tax regime that will be taken up from January 1, 2026. So I must say it's a pleasure having you around, sir. Thank you so much for coming around to talk about this.
I'm happy to be with you today.
You're welcome. So we are just going to get down to the basics, right, and have an understanding around Nigeria's 2026 Tax Reform Acts. What are the key features of these acts, and what are the notable changes that we should be accustomed with?
All right, thank you so very much for that. Let me start from the broad objectives of this tax reform, as we call it. And there are two. Two in the sense that number one is to harmonize what existed before now. And I've been a part of that conversation the last maybe close to 28 years. Been talking about the plethora of taxes in Nigeria. At the last count, we had over 7 taxes, levies, dues, charges across the national, subnational, governments in Nigeria. So it's been in so many conversations. So having the courage and the commitment to do it now is a good development for Nigeria. Bringing that number to single digits, that is number one, the harmonization. Now the second part to it is to strengthen what we call the taxpayer behavior. Okay, it's a global phenomenon, it's a challenge all around the world. But what countries do differ from one geography to the other. So, but what we've noticed, which is a key component of this reform, is that we introduce features that will strengthen compliance and then comply also with what I will refer to as the basic theories of compliance. And there are 3 of them that are reflected in this. Number one is what we call the deterrence theory, which balances economic gain from evasion, okay, vis-a-vis the economic sanction, which means if you weigh them on the balance, which one is heavier? So if the sanction is heavier than the gain, there's likely to be right behavior of the taxpayer. The second one now says, okay, let's seek a balance between what the taxpayer gets in return for commitment to the state. And then, of course, the third one says, look, let's look at it from this perspective. Behavior in terms of choices and decisions followed by actions. All right? It now says people make a rational choice when they can see a reason for that. So which balances the first two I mentioned. So essentially then what these reforms have done is to bring all this into context, which is narrow the space for evasion and avoidance, and also at the same time look at how to enhance revenue thereby. So which means there is no reference to increasing tax rates. It's important to make that point. No increase in tax rate. But what has happened is harmonization on the one hand, and then bringing technology into the fray to ensure that we narrow this space for evasion and leakages.
Does that mean that we are looking at the total elimination of multiple taxation with this harmonization?
Excellent. That is what this has done by reducing the number of taxes and levies from above 70 to less than 10 in number. And that's quite significant.
Of course. But then don't you think that government will be losing revenue? I mean, it's one of the things I spoke about off camera. Wouldn't the government be losing revenue by freeing, most especially small businesses, from paying their taxes through this?
All right. Excellent question. Now, there are two perspectives to that. The first one is looking at the number of MSMEs vis-a-vis the total number of registered businesses in Nigeria. They are above 90%. In fact, by the time you take the micro, small, and medium-scale enterprises, you'll be counting close to 99% of registered businesses in Nigeria. But when you look at the volume of trade they do, it's far, far insignificant compared to what the 1% large ones generate. So which means if most of these small ones are exempted, the revenue loss to government is very, very minimal. But the gain on the other side is that if the 1% thereabout that are big and create a lot more value, actually pay tax as specified in the statutes, the government should get more revenue. That's the first side to it. Now, the second side to it is, and this is proven by research, that is evidence, because this reform also has embedded that in the next 3 to 4 years, there's going to be a reduction in the tax rate, this corporate income tax rate, from 30% to 35%. So which of course will make people say, oh, is government going to lose revenue here? But there's research evidence that shows that when you drop the tax rate, usually you incentivize compliance. And of course, the government gets more revenue.
Okay, so I understand that the onus, or should I say the responsibility of number one, facilitating understanding, facilitating compliance,
That's right.
even implementation and balancing between fulfilling statutory obligation and of course strengthening, or should I say making customers happy. Now that responsibility lies on part of the directors of companies.
Indeed.
So I'm going to ask now, how do you think they would be able to go about this, especially when it comes to understanding their role in interpreting these new tax laws and ensuring that people get to comply?
All right. Very good. Now, there is this common principle we say, you can't give what you don't have. All right? Which means for directors to play their role effectively, not only in terms of oversight generally of the enterprise, they sit on the board, but with respect to these new tax statutes, they need to understand it themselves, which means they must be open to learning. Now, the second part is their responsibility, which is in terms of oversight. Oversight becomes effective when there are internal policies that are documented, not in the head of somebody. They're documented, which means whoever the CFO is, in some organization they have somebody also specifically appointed to handle tax matters, all right? It must not stay in their minds. It should be documented as a policy, in which case every company should have a documented tax policy, which will spell out what responsibilities they have towards government on the one hand, and then also to their own customers. And it's important to mention that. But one of the things also put out as the benefit of this tax reform is that eventually some entities will pay less tax. And it's assumed in this new set of laws that the tax benefits will be passed on to their consumers in the form of lower prices. So again, that becomes a responsibility of the directors, who ultimately will have to make that decision. All right. So how do we do that? And of course, if you look at it from the business perspective, what you are saying in essence is that if I drop my price, I will likely get a lot more patronage, so I can make more money. And then the other side is the fiduciary responsibility, which also connects to the responsibility of the company to the government. So as civic responsibility now. So you are not only expected to be forthright, following the 4 principles of International Financial Reporting Standards, especially the area of measurement and then recognition of your income and of course of your expenses. That's the first principle. These tax reforms also specify that, because every director will be held accountable for correct recognition of your income, that's revenue, and then your expenses. That's where it starts from. Then it goes down to the second principle there, the measurement of your assets and liabilities. Which means the values you put in the books that you submit to tax authorities must also reflect the opinions of the professionals in that particular asset area. For example, you own a real estate asset as an entity. So who puts the valuation that goes to your accounts, as your financial statement? It must be somebody who is a real estate valuer that will submit a valuation for that. So you can't put any arbitrary number going forward. So if there's a disparity between what you disclose in your financial statement and the actual value, under this new law, you're liable. So there will be sanction for the company itself, and also in some instances vicarious sanction for the director as well. So we must therefore be aware. And these particular new statutes are very specific on that.
So based on what you said, it just shows that there is some sort of a modus operandi when it comes to driving conversations around Nigeria's tax administration.
That's right.
Most especially on the part of the directors before they trickle that knowledge, of course, to their customers. So I'm just going to put it this way. It involves strategy, so to speak, to get all this done. So when you look at company income tax, petroleum profit cash at pioneer status, capital allowances, strong economic presence with another. How do all these affect tax strategy?
Excellent. Now, what all of this speak to, there is no difference between the rates we had before. And I'll use a very simple illustration. Corporate income tax, CIT, at 30%, all right, of your taxable income. It's not to all of your income, your taxable income. Then it also says that in the event a company makes a loss, then it will be 0.5% of your turnover. It had always been like that. It didn't change. So it didn't change at all. It's still the same requirement. But now it comes to your returns. Okay? There are 22 different types of returns. Different companies around the economy are required to file. So but this now specified, some of them are like reminders of where to file them. So the first of the succeeding month, some okay, but before the end of the half year, that's about CIT anyway. But if you operate in the petroleum industry 5 months after, there are some things, maybe royalty on solid minerals and all of those. They now have clearly specified. You can't therefore claim ignorance in this matter. Clearly specified. And of course, the basic reason for all that. So they are very clearly specified in the new acts, all right? So that is very clear. Now, when it comes to, capital gains tax, and that is the one there's a lot of misunderstanding going on currently. Now, capital gains tax in the previous statute was a flat 10%, okay? But under the new law, it says, because that difference between that 10% capital gains tax and the 30% CIT, corporate income tax, created a strange arbitraging opportunity where some entities will claim that the tax they're entitled to pay is under capital gains tax, CGT, whereas it's supposed to be under corporate income tax. So what the new law has now done is to split income into, parts. The first one is your trading income as a corporate entity. If you are trading and it is trading income, it's understandable what that is subject to. If it is now, of course, gains or the disposal of an asset, it also becomes very clear. So where then there is a modeling up, what is law done now to separate them, so it becomes very clear. So no controversy whatsoever. If you see what is happening in the capital market now, that is what is reflecting there. Some are claiming, oh, investors are jittery. I say there's no need to be jittery. You operate in the capital market, it even says that, look, if you make gains in the capital market in a whole year, if your gain is not up to 10 million, it doesn't even apply to start with. Okay? So a whole lot of misunderstanding. And that's why I'm happy about this conversation. So making people understand that, look, at the end of the day, get to understand this by either attending symposium, workshops, and the rest of them. January 1st, 2026, no excuse. Because the laws become effective. So it's better to prepare now before we get to that point.
All right, sir. So, although you had mentioned it in passing, but I'd like you to talk about how boards can manage transfer pricing and tax planning risks.
All right, very beautiful. Incidentally, these are now for the first time also specified in the statutes. So previously, every entity would do its own tax planning internally. And I give an illustration. In my days in banking in the early 1990s, I was head of strategy then in FCMB, okay? Part of my job then was to do tax planning for the bank. In which case, which kind of sectors of the economy, what kind of transactions should we do? Because there are inherent tax benefits if we fund customers in that space. In those days, if we gave a loan to an agri enterprise, there is a 33 1/3, tax benefit in doing that. So we focused on lending to agribusiness at that time because we get tax benefit. So as part of tax planning, that was a part of the strategy. Okay. So what these new laws now say is that, look, there's nothing wrong with tax planning. But when you have your tax plan, you must submit it as a document to tax authorities. The idea then is that they are empowered when they come now to audit, that's to conduct tax audit, or for any reason, and the law also states, I think, close to 10 reasons why they can instigate a tax investigation. Let's say, for example, there's a massive increase in your revenue, okay? That will warrant a tax investigation. Why is that so? And a couple of other things are mentioned in there as well. So all of these are recognized, which means the challenges that entities have been having over the years, gray areas, transfer pricing, for example. Let me mention a clause that is also in there. What it says is that if you have two entities that are related, okay, in the past, they could play across each other using transfer pricing to move value around to avoid tax. But what this law now says is that, look, if you are related, you'll be treated as related and as one. In which case, transfer pricing now will go to the original conceptual purpose of it, which is like, okay, we are two entities. One sources a material for the other to use. So how do I price that? Without mentioning names, I've audited a company some years back now that had federal government, investment in partnership with a foreign company. And this company was a serial loss maker. By the time I got in there with my team to audit what was going on, we discovered that they were playing on transfer pricing. In which case, this company will source material for its related entity, but in pricing that material at the sale to them, it will be priced lower than the market cost. So that way, the company will always be at a loss perennially. So the question now the MD of that foreign company asks me is that, why is your own client interested in buying out the shares of federal government in this entity that is making losses? I said, well, because you are manipulating transfer pricing. The man went silent. And America, he went silent. Okay? So, of course, ultimately, they now came back and said, okay, they are not even interested in the business again. We are selling to you. So this law also recognizes that there are a lot of manipulations in that area. So it is clearly defined what are the principles behind transfer pricing and how should it be done, so that the actual value being transferred is transparently done. That's what is in there.
So basically, we are looking at a set of tax laws that seems to plug the loopholes,
Yeah.
and try as much as possible to solve the inherent challenges that has made it impossible for this particular Nigeria's tax administration to generate more revenue as needed. So I'd like to also find out for companies that will be looking at internalizing this, because I must say it's a right to to imbibe, so to speak, before you now begin to translate into things that can be operational. Now, what operational or compliance issues or gaps are there that might actually affect or expose a company?
Well, let me speak to two things here. The first one, I made reference to that earlier, and that is filing of returns. This puts a big responsibility of filing returns on time, because companies used to, on occasions, miss the deadlines for filing returns of some of these, taxes, various taxes we are talking about. So this is clearly specified. Like I said earlier on, no excuse whatsoever. All right. So because now it says if you miss it, there will definitely be sanctions. And I give an illustration. Okay, for a company that doesn't file its income tax returns, okay, the first month it misses the filing, it's 100,000 naira. Subsequently, for every month missed, it's 50,000. So now, if you look at the company delaying that for maybe 1-2 years, we've seen that in some instances of significant enterprises that are listed on the stock exchange. Now, don't see their financial statement for 2 years and longer. So the sanction now is clearly defined and is heavier. So that means they are motivated to comply rather than not. Okay, that's on the one side. And there are a couple of other sort of provisions. Now, the second element here is looking at the, not just the returns per se now, but the value that you derive from compliance. That talks about the ethics of it. Because you don't want a situation where, as a director, you sit on the board of a company and then there is a news report that company is in violation of the following statutes of not only tax but some other requirements from you legally. That doesn't speak well about that entity. We call it brand damage, reputational damage. You want to also avoid that. So that means you must not only be aware, but have the structure in place. Now, one of the things I also advise directors to do is that it is not enough for you to receive reports. In fact, this should become a core element in what I call the risk dashboard that boards of company should have. Risk dashboard means every quarter when directors have their meeting, the quarterly board meetings, okay, the risk management report, we also have a risk element in the risk register that now tracks how we are complying with tax requirements. So it becomes something directors should also insist should be added to the tax register.
Okay, so now, how do you think boards can actually balance shareholders, employees, communities, and state concerns?
All right, very beautiful question. Now, we call that the agency theory, in finance and also in businesses. What it means simply is that directors are agents of shareholders, okay? The executive management is the agent of directors. So, but ultimately, we are all accountable to the shareholders, but government and its agencies also are an important constituency in what I usually call the corporate governance structure, architecture, all right? So what this means then is that you want to recognize the fact that directors are central to all of this. What we expect of directors is to also do an impact analysis of this new policy and then play multi-scenario, exercises of what happens to us. And I'll give a simple illustration of that. There was a young man who lives in the UK working for the bank, and then he was given a promotion by his employers. And the young man said, no, I'm not, I don't want a promotion. Leave me where I am. So I asked him why. He said, well, if he accepted the promotion, his tax liability will increase. So his take home will drop compared to what he takes home now. I said, wow, this is interesting. This is a true life case, true life story. So now it means that when we get to a tax regime like we are entering from 2026, then directors must become more conscious of the implications of those policies. But it also goes on the other side, that it's not only enough to know the implications, that should also motivate directors, especially in our institute, okay, to do strong advocacy. Because no statute is perfect anyway. In which case, if there are gaps, and there are gaps in any case, that we have identified already. So we should begin the advocacy from now to see that those amendments are made to the statutes in the course of time.
So if we talk about directors' need for consciousness when it comes to most especially detailing the process. Now, how can tax oversight be integrated into enterprise risk management?
Beautiful. Okay, now I mentioned that earlier. You have your risk register. Every company has its own risk register. What are the risk elements we're exposed to? And then you develop the dashboard, which in my own description, that's what I do anywhere I serve. And that is, what is the meaning of this particular risk element? Now, what will be its impact? Then we look at how do we measure it? How is it? Then we use the traffic lights concept. Is it red? Is it amber or green? Okay. So whichever one it is, we then ask ourselves, the board meets every quarter. So the last meeting we had, what was the level of the risk in that particular element? Was it red? Has it turned yellow now? Has it turned green? We want to see how it transits between the quarters. All right. And then there's a column that puts a remark. That is what we do about the risk element over this new quarter we are entering. So the same thing will now happen with tax compliance. Tax compliance will become a risk element in the environment we're going in. There's something I should have mentioned earlier. I think it's good to mention it now. These tax agencies, government agencies, this new law also provides for them to exchange information. Take, for example, let's say the Nigerian Revenue Service, that's the new name of FRS, okay, comes to audit. And they found that there's a particular tax your company is supposed to pay, but it's not under their own purview. Just to illustrate, the agency in charge of that, NRS, will share the information with them. And even on occasions, they can also invite them to join NRS to come do a joint audit. That's one. Then two, in this law, because I haven't mentioned that yet, banks and other financial institutions are also mandated to report on a quarterly basis. Individuals that do transactions turnover on their account of over 20 million. And then for companies that have turnover of over 100 million. So if they file those returns on a quarterly basis, that means, ladies and gentlemen, there's no escape. And that's the digitalization aspect to this. Because you had that question earlier, what are the key features? That's another feature of it, digitalization, which means technology is coming to the space. Once you bring technology in, it also makes information readily available, and there's no room for playing what I call arbitrage.
Okay. Yeah. So yes, I was going to ask. In developed worlds, most of them have actually incorporated technology into their corporate spaces, but we still see some individuals and institutions who still evade tax.
Yeah.
And earlier on, you said that with how robust these tax reform bills will be coming on board and taking effect, there's no escape routes.
Very tight. It's very tight now.
Are you saying that these new tax rules, by the time they take effect, it will be total? There will be no loophole. There would be no room for somebody circumventing the process, and at the end of the day, running away with what should statutorily be the government's approvals.
Yeah, I like this question because in any human system, nothing comes in the absolute. There will always be gaps. For those who are creative enough, there's this joke we make that in every company we encourage creativity, but not in the accounting department. I know what that means. Okay, so some people will still make efforts to identify loopholes and see how they can exploit them. But what this also means is coming back to the tax authorities, that on an ongoing basis, they also be tracking the system and then making an update to tighten the loopholes. Like rightly said, this happens in the advanced economy that already had technology built into the system, over the years. But one thing I also like about this is that it comes also with the office of a tax ombudsman, which means, and this is something I've personally advocated for many years across different African countries, that African tax systems are weak in redress. Redress means as a taxpayer, I have a complaint, but there's no legitimate window for me to submit my complaint. So because it is law, I have no choice. I have to comply. So I comply. Talking about the personal experience, we are resident in Lagos, okay? And I was given my tax bill, and then they came back, did audit, and said, oh, in the last 5 years, I didn't pay it. I said, how come? But over that period, my tax ID was changed. So the payments I made went into the old tax ID. So the new tax ID showed that I hadn't paid tax. So when they did the reconciliation, they came back and said, I had outstanding of this much. Now, because there was no space for me to seek redress, I said, look, I don't want anyone to accuse me of tax evasion. I started paying in installments up until I overpaid. Now, it now got a point that I submitted my self-assessment. Lagos State, LRS now came back and said, look, we have credit to your account as much as this. So you only pay 89,000. So you have a credit of over 2 million, which means what we accuse you of not paying, when you started paying, you overpaid by over 2 million now. So, but now this new tax law provides for the office of tax ombudsman and gives room for taxpayers to seek redress. All right? But of course, immediately that is reviewed and everything is done, there's a clause also in that law that talks about final and concluded. Once the redress is finalized and concluded, whatever the outcome is compliant and follows. But at least that we know it there. I'm happy about that.
Okay, so I like the fact that you've been there, done that in Nigeria's financial and tax ecosystem. You've seen it all. You've seen how it plays out, and you would have had interactions with the board, with several directors, different companies. From the assessments, would you say that they are they have the expertise when it comes to knowing what this new tax regime is all about? I mean, basically, if we are going to be implementing it by January 1,
Yeah.
even the directors themselves, they are the heart of this and should be able to man it, most especially to avoid, companies running foul.
Yeah.
All right. So do you think they have that requisite knowledge of these new tax regimes? I'm looking at multinational companies too, because we can talk about small businesses, we can talk about medium. What about multinational companies that might have several financial portfolios? I have a board that will have to sit over that.
Yeah.
Do they have the capacity to manage?
Now, incidentally, in terms of the corporate governance, guidelines and rules, there's a provision for a director of a company who lacks the expertise and the knowledge of a particular issue on the table to actually engage a professional in that space, and the company will pay for it. That's allowed by law. The company pays for the expertise to help you interpret the issue and therefore bring directors to speed in terms of knowledge of that issue. So companies have therefore opportunity to retain consultants. There are tax consultants. I'm not one, okay? There are tax consultants who do that for a living, okay? So in which case, if for example, I sit on a number of boards, but because of my exposure in the area of risk management, anywhere I serve, they get free consulting for risk management. So I help them overhaul the entire framework, the policies and all, okay? So that is in answer to your question now. If there's nobody on that board who has the competence, the law also permits them to hire and pay for it. But it must be done in a transparent manner. Okay. So that's the key thing there.
Okay. So yes, Ella, you talked about the need for aggressive campaign to facilitate understanding about this tax regime and all.
That's right.
So I'd like to find out. We know that there is no. This is Nigeria. Or should I say this is Africa? There's no amount of explanation or explainer, whatever it is, that would actually placate curiosity on the minds of so many people. A lot of people will not be satisfied.
Sure.
So how do you think the board can be readily prepared for public scrutiny?
Okay, very important. So it's a key element also, not only in this tax statutes, but also in International Financial Reporting Standard, the fourth principle of IFRS, and that is disclosure. So which means that as a director, you have responsibility for disclosure of what is happening in the entity that is also benefiting from the geography where you generate that income. So in which case now, you then, as a director, have a responsibility to learn, that's to expose your minds to this, in as much as to say the government agencies, the reforms, committee and the rest of them, they have responsibility to educate the public. But directors should on their own also go out and look for opportunities to get educated. Because the more you know about an issue, the more control you have over the issues therein. So, and that is my advice to directors. We don't need to wait until January 1st, 2026, but between now and then, any opportunity to learn, like the symposium that CIOD is organizing this month, the tax symposium, you want to make sure you attend, not only to learn, but have opportunity to ask questions about gray areas to you. Or what might be great to me might not be great to you. So, but when we come together at such, an event, it's an opportunity to learn. Just like the typical thing we say, I give you 1,000 naira, you give me 1,000 naira. We check our wallets, none of us has increased. But if I give you an idea you never had before, you next year give me an idea I never had before, the two of us have increased in our knowledge, all right? So that is the kind of thing that happens at such events. They should be aggressive in looking for such opportunities to learn.
Now, what do you think the role of advisors and audits too can be in helping to guide the board along this way?
Oh, yes. I will expect, for example, that the board can request from their auditors to give them a brief on these statutes, and especially how it affects their own organization, knowing that the effect of sectors are different depending on where you operate and the nature of your business. So, but a board, for example, can request its auditors to give it a brief of what these new statutes mean. And I will cite an example. When COVID impacted in 2020, okay, there was something I did for Deloitte. It was, of course, pro bono. Okay, Deloitte said, look, you do an interpretation of how COVID is affecting economies, businesses generally. Can you do this for our tax clients? I said, no problem, because we have a relationship, okay? So I did it for them for free, but it was on a platform for about 1,500 clients, tax clients of Deloitte. So that kind of thing means that every board can make a request to its auditors to give them a brief, especially focusing on how these new laws impact their own business and how they should prepare for it. And I expect it should be pro bono.
Well, if it can be afforded, but definitely. Okay, so we are crossing home now. I'd also like to find out in terms of immediate compliance with these tax laws.
Yeah.
And long-term plans, because definitely it's coming to stay.
Sure. Yeah.
It's coming to stay.
Yeah.
What should be the priority of the board, and how can they plan it
Good.
to strengthen, their hands over this course of action?
All right. Now, this is about mid-November. That means we have 1.5 months to get to the commencement of implementation. So every board should take advantage of this period to set some things in place. Number one is to develop tax policy. Tax policy means documented how we'll engage with the tax requirements of Nigeria where we do business. That's number one. Number two is to be clear about who takes responsibility for that. And then also, of course, that would have been stated in the policy that compliance is non-negotiable, which means even internally, a staff can get sanctioned for making us not to comply. So there must be an internal sanction before the external one. Perhaps we want to say, look, we know the sanction for missing filing of our VAT returns, okay? Which is the deadline is 21st of the succeeding month. If we miss that, we know the sanction by the law. If it happens to us, you will pay it from your pocket. If we debit your account and we start deducting that from your salary. Now, such a staff, we get serious about it. I want to ensure. For example, the boards where I sit on, when you bring the compliance report, one of the things I want to see is whether we violated any requirement, okay? If you report to the board that, this quarter that ended, we did not miss any compliance issue, so there's nothing to report here. No violation, no sanction. That is good, thumbs up. So, but if the board will require that as part of the quarterly report, then it means somebody within the enterprise will take ownership and responsibility for it. So, but that must also go along with sanction, as I said. So those are the kind of things that should be put in place before we get to January 1st. If they're in place, then we are in a good position.
All right, sir. So how can tax strategy now align with ESG objectives of a company?
Very good. Now, ESG is a global phenomenon that says, as much as possible, we want to ensure that we play the three P's, as we call them. And that means profits is important as a proof that we are running a sustainable business. But people are also important because people on both sides of a business define what the business is. Like I normally say, your company is a name on a piece of paper, certificate of registration. But what gives this life are the people working there. Okay? So the people working there are one side of the people, customers are another side. Okay? So the second P there is people. The third P is planet. So the idea of ESG then is that there must be a balance in how all of this interact within your operations. For example, if you say, look, ladies and gentlemen, in our organization, we no waste paper. Why won't we waste paper? Somebody will say, oh, it's good for cost. It goes beyond cost. Because for every piece of paper in our hands today, there was a tree in the forest sometime in the past. That tree was cut, processed into pulp, the pulp processed into paper. That's why we can hold it today. So the less paper we use, that is going paperless, for example, in context of ESG, the more trees we have retained in the forest. And then look at the ecosystem, the exchange of carbon dioxide and oxygen between humans and plants. Okay? So you are helping the environment. That's the E part to it. The social means people generally. And of course, governance means, I put governance in a very simple manner, the way we police ourselves. Okay? Which means there is a balance in everything we do. So that means we take care of not only the people inside, we also consider the people outside. And of course, we recognize our responsibility to the authority, and that's the government in terms of taxes and other requirements that we want to comply with. But we think also of the future, which means at every decision, every choice we make, every action we are taking in our organization, we are thinking sustainability, and that's the future. So talk to so many things. How we use water, we use electricity. Yes, all of this, saving them is good for business in terms of cost, but it also connects to the environment where we're operating. So the more attention we pay to ESG in all that we do, the more sustainable our thinking is, and the longer our enterprise will last.
All right, of course, I believe so. So, as we'll wrap up on this. So I'd like you to just probably just a minute,
Okay.
demystify any of the fear that you probably might have noticed, probably in interactions with people. Let's even look at it from the angle of the taxpayers, who might still be skeptical about some other areas that they are not knowledgeable about. So I'd like you to, just in about a minute or two, debunk those fears and help them understand that is a new tax regime that helps all and benefits all.
All right. I will say two things there to make it very brief. The first is that there's no increase in any tax rates. VAT still remains 7.5%. CIST still remains 30%. Okay? So there is no increase in tax rates. So we need to all understand that. That's number one. Then secondly is the fact that if you have a mind to comply, and that is you are ethical, and in your organization you run by corporate governance principles, which I normally describe this way. Good corporate governance, it makes common sense, but it's not common practice. So in which case, what this is guiding us towards is right behavior, which means good corporate governance as a practice. So in which case, if you comply with the rules, you have nothing to worry about this new tax regime. It is those who have not been compliant. I want to continue in that attitude and conduct that have things to worry about, because now this window for continuing that behavior has been narrowed, and it will continue to narrow as we not only adopt but also deploy technology in administering tax in Nigeria.
All right, thank you so much, Mr. Biodun Adedipe. Thank you so much, sir. It was nice having you around. Thank you so much for sharing his part knowledge with us. And we hope that a lot of people who are actually going to be watching this would be more informed. I would be more aligned to what the Nigerian government is trying to do within its tax ecosystem. I mean, it's all about revenue for all, for development,
That's right.
infrastructural benefits, not only for governments,
That's right.
basically for the people. And if we all comply, then we all get to enjoy the benefits of our compliance.
That's right. That is social compact, as we call it.
Definitely.
So we give to government, government gives back, and we develop.
All right. Thank you very much, sir. So that's about it on these segments where we get to, of course, help you understand what the new tax regime is all about. It's not a cut your neck. It's not a deep cut, so to speak. But then it's to help you understand that you have an obligation to fulfill, even as the government has its to also do. Directors of companies also have their role to play, advisors, auditors. Everyone has got a part to play in ensuring that by January 1, when these new tax laws come into full effect, we all are going to be actively participatory and, of course, active beneficiaries of what the government is trying to achieve moving forward from this time on. So just like my guest said, if you comply, there's no need for you to be scared. I'm not scared. I pay my tax, you pay your tax. Everybody's happy at the end of the day. My name is Lekon Obanjo. Enjoy the rest of your day.